Hey guys, Incredible Crypto here with a new market video update. This is the first update I've made in over 3 months, and that's primarily because there was no change in my perspective or expectations on Bitcoin or where we are in this cycle until and unless this key swing low at 74K was broken. And today we've broken that key swing low, and that is why things have now changed, and I think it's actually worth making an update. Now there's a lot to cover in this video, and I'm going to try and do it in order that makes the most sense. So I'm going to jump into this. There will be timestamps at the bottom of this video if you want to skip to a specific part of the video, but of course, as always, I recommend watching this video through and through. The reason that I make one video a month or one video every few months is because I like to only cover what's needed to be covered. So everything that I talk about when I do make my videos is typically important. So with that being said, this might be a long one, but again, I recommend watching it through and through. Everything is going to be important. A lot of people tend to skip through, they miss a lot of the context, a lot of the nuance, and then months later they're lost and they say, wait, but you said this, and I'm like, yeah, but did you watch the rest of the video? So with that being said, guys, let us start off with the highest time frame outlook, okay? And we'll talk about the idea that I've had on Bitcoin since it was trading at $3,000 here in 2018 to where we are at today, and how the current move below 74K is relevant in that context and the implications moving forward. As I mentioned on Twitter, there's a few different topics I'm going to be covering, so just a brief summary of where this video is headed. I'm going to cover both bullish and bearish scenarios on Bitcoin now that 74K has been breached. I'm going to cover what the lack of a blow off top here may entail. I'm going to cover the reason why I don't focus solely on indicators. A lot of people have been talking about indicators suggesting that we're in a bear market, or indicators suggesting that a large move down is coming. I'm going to go over those because trust me, I've seen them all, and I'm going to talk about my thoughts on that. So with that being said, guys, let's jump right into it. Here's the high time frame of Bitcoin, and the idea was quite simple. Ever since we were at 3K Bitcoin back in 2018, I said I'm looking to hold my crypto for the rest of this entire cycle. This cycle meaning a full five wave, uptrend starting off the lows here at 3K, and the idea was we're holding spot till the end of this cycle, and I'm not selling before. And a lot of the reasons for this are tax implications, and that is a topic for another video, but a lot of people underestimate the impact of taxes when they are actively buying or selling crypto. And so for that reason, the idea was to keep my spot and trading portfolios separate. So I actively trade on one portfolio where I'm actively trading all the swings that you're seeing on this chart on every time frame. And then I have another portfolio that I've been holding essentially since 2018 that the idea is to simply accumulate and not sell until the end of the multi-year cycle. Let's talk about where we're at in that cycle. So going back to 2018, we completed our first impulse, as we call it, of the cycle up to 13K. We then saw a correction back down to about 3,800 on this chart, but on other charts we went down as low as 3,400. And again, this is a time where those of you who have been following me for some time will remember many were very bearish and I was very bullish. Why? Because we had not retraced below the lows of the prior impulse, which was down here at 3150. And I said, as long as you don't go below 3150, it doesn't matter how deep we go here, what's next is another impulse. And that's what we got. And you'll see this recurring theme because, again, this is the method that I use of identifying essentially major pivots on a chart on different time frames. We call them origins of impulses or origins of an uptrend on some different time frame. Those origins are significant levels or pivots on the higher time frames. And so you'll often see me refer to the origin of the impulse, which basically just means the start of some level of uptrend on a chart, and that is the key relevant period, right? So if we make a massive move to the upside and then we retrace most of it, as long as we put in a higher low somewhere above the origin of that massive move, the rest is irrelevant. The depth of the correction doesn't matter as much as the fact that we didn't break this key level of high time frame market structure. And that is why we remain bullish despite heavy drawdowns on the higher time frames. Now, after we put in this higher low, we break the highs again. That officially makes this a high, a higher low, and a higher high. And this establishes what is then potentially a larger uptrend. In the larger uptrend, we make another impulse move. Again, this one, some will argue, began at 3.8K. I've argued that it may have begun here at 9K. Again, idea is the same. Once we put another major high, another major top, we look for the next major high or low. As long as it is above the origin of that impulse, it does not matter how deep we go, the expectation is that another major impulse will follow. Again, this is a recurring theme, and you can apply this not just to the highest of high time frames, but you can apply this to lower time frames as well. So oftentimes within these larger moves, there have been key pivots or key points where I've been steadfastly bullish when many others have flipped bearish. This 9K level here was one where we moved down from 12K, we came back down to 9.8K. Invalidation was here at 8.8K, just $1,000 lower. We never hit it, we moved up. We've seen the same thing happen time and time again on our way up during these major impulsive moves. The only difficult or tricky part about this is that at certain points in time, you will start to break these levels, right? Every uptrend has to end, every downtrend has to end. So at certain points in time, you start breaking these key levels of market structure. If we go back to when we were moving up off of 3K, and we can go down to lower time frames to do this, this was the original impulse. We corrected most of that, came down to 3.3K. Once again, bullish here, and I said, as long as it doesn't go below 3.1K, this is a higher low, right? Despite the fact that it retraced most of this move, what follows then is another impulse, which is local low, high, higher low, higher high, higher low, higher high. That's again a little uptrend. So we had another impulsive move here. That makes this the new invalidation at 3.3K. We retraced about half of that move. We came back down to 3.6K, didn't go below here. So we expect the uptrend to continue, and so on and so forth. And we essentially repeat that with a series of uptrends on different time frames, right? And as long as we don't breach those key levels, those key origins of the local uptrends, we expect the higher time frame uptrend to continue. And so that's what we got here on Bitcoin at 3K. We kept seeing consistent higher lows, higher highs, higher lows, higher highs. And ultimately that led to what was kind of like a little parabolic advance of the time frames and then a major top. Anytime we go straight up, straight vertical like this on different time frames, that typically means that the correction that follows when we do break structure will be more significant, right? So Bitcoin here, even at 13K, last key major low was this low right here. And this low was the end of this corrective structure, which again, a corrective structure is, long story short, some sort of a consolidation or ranging structure, and you can view this as a range, right? The different terminology for different methods, it's all the same stuff, just different ways of labeling it, right? But we'd call this in LA way, we call it a running flat. Running flat is essentially a range that forms. We take the highs of the range and we fail to take the lows of the range, and then we continue upward. So in LA wave, we'd consider this the range, and you can see here, we formed a key swing high, formed a key swing low, took the highs of the range, failed to take the lows of the range, and continued up. That we call a running flat. Another LA wave structure would be an expanded flat, and that's where we take the highs of the range, we take the lows of the range, and then we continue. Both of these are just corrective structures, right? And essentially they're consolidation phases in one way or another, whether you consider this a range that we consolidated in, or whether you consider this the larger range. They're all just different ways to describe some sort of a sideways, non-trending, ranging structure, right? And those non-trending ranging structures occur in between the larger trending structures, which are what we call impulses. So you have impulses and corrections, two phases of the market. And the idea is that wherever these impulses start, they mark the start of some trend on some time frame. And so if we get a correction, no matter how deep or ugly or aggressive it looks, as long as it doesn't breach the origin of that impulse, the expectation is that we continue higher. And that is how we typically avoid these mid-trend shakeouts, like this one that we saw here when Bitcoin dropped from 8,000 to 6,000. Okay, now it did this very rapidly. This was a 4-hour chart. This probably happened in around the day. Now it's easy to say in hindsight, to look at this in hindsight and be, well, the chart still looks healthy. But I will tell you that anytime in these markets when we see a violent drop, right, of this magnitude, which essentially erased 50% of the prior rise off of this low, anytime we see something like that, the sentiment at that time is not so bullish. Sentiment at that time is typically one of fear, one of doubt, one of thinking that, hey, this was a temporary relief rally in this bear market that we've been in since 20K, and now we're headed back down. And I can guarantee you that all the way up on this rally, we had people calling for lower lows below 3K. And that is because their methods of evaluating these structures, there's no like set methodology for these decisions or expectations. It's more based on going with the price action in the moment and kind of moving with your emotions. So anytime we get a big drop, people get fearful and they think there's a bear market coming. Anytime we get a big pump, the opposite happens. But when you lack some sort of framework to evaluate these moves in the context of the bigger picture, it makes things very difficult. And so the idea is that if you want to hold to the end of a cycle, if you want to hold to the highs of a cycle, you have to have some framework of evaluating the significance of every drop that occurs on the way up. Because again, like we saw in 2017 or in the bear bull market of 2017, and I can just go out here and show you guys, on Bitcoin, on its way from $150 to 20K, we had a number of high time frame dips that were significant, right? So here's one, we had a 42% correction here, we had a 43% correction there, we had a 34% correction there, we had a 34% correction there, 37% correction there, we had a 39% correction there. So almost like 6 to 7, 30 to 40% corrections on Bitcoin on its way to what was ultimately the blow off top in the end of the cycle. If you're gauging the seriousness of a correction based on the percentage of the drop alone, that's going to give you a lot of false bear markets, right? A lot of fake outs to the downside. It's going to prevent you from actually realizing the largest amount of gains, which will happen during peak euphoria or a blow off top, as we call it, at the end of any bull cycle. And so it's very important that you have some framework with which you're evaluating these drops, as opposed to just saying, well, we fell 40%, how can you not call that a bear market? And the proof is in the pudding here. When we've done that 7 times in 2017 on a rally to 20K, it should not surprise anyone that we can't just assume that a 40% correction is the start of something deeper. So again, with that being said, our framework has been the same since these lows at 3K. And when we finally do top at some point in like a mid-level trend, the trend off of 3K to 14K was significant on that time frame, but at the end of the day, it was a move from 3K to 14K, right? So it is significant, but it is only relevant on this time frame. And again, time frame is also relative as well. You could consider this a daily time frame, you can consider this a weekly time frame. But my point is that the trend on this time frame, when it did break, which was finally on a move back below this key swing low, because it's the start of this last impulsive move, when we finally broke 7K after topping at 14K, which again is a 47% move to the downside, this is our first confirmation that the drop is not a fake out. Again, we had a 25% drop here, which was pretty significant. From this low here, we had a 20% drop, but this was the first significant drop that actually broke our higher time frame market structure. It sucks that it was a 50% drop before we could conclude that we'd finally ended this run to the upside. But the reality of the situation is that in a volatile market like Bitcoin, as we saw during the 2017 run up, 30 to 40% corrections happen more frequently than we realize. And so again, we can't just call a bear market or call the end of the rally every time we get a 30 to 40% correction. There has to be some basis in which we do that. And again, I would love for this last impulse leg that happened here to have started off of 9.5K, right? I would love to have had our invalidation level a little bit closer. That would have been nice, but I can't control what the market gives us. And in this case, the market gave us an impulse starting off of 7.4K with a nice 100% move to the upside before this rally ended, right? So again, these levels that we choose as levels of invalidation, they're not arbitrarily chosen because we feel like choosing 74K, for example. There's a reason and there's logic behind why we make these decisions. And sometimes it works out in our favor, sometimes it doesn't. When we have a very clear invalidation level, like the origin of an impulse back here at 3K, and we get an 80% correction of that move, that gives us a very high risk to reward entry, right? If we're expecting these lows to be defended, if we've retraced 80% of this move, we can enter here, stop loss here, and we can catch a massive move to the upside. At the same time, it also means on the downside, we can't assume that the rally is over until and unless this level is broken. And you can see why for good reason. If someone saw this rally and said, well, we retraced most of this move, it's clear we're going back below 3K, I'm going to sell my Bitcoin here, well, then they just missed out on the most significant rally of the early stages of the bull market. I understand people's frustration that we didn't get confirmation that 74K was broken, but again, there's logic and reason behind that level being chosen. We'll go over that more here in the video. But once we had this break of this structure, what that told us was that this move off of 3K was finally complete, okay? And at that point, what does that do? That opens up the doors for potentially a much deeper correction, which is exactly what we got here a few months later, right? Now, again, this doesn't mean we have to correct this deep. It doesn't mean we had to back here either. We could have very realistically bottomed out right here at around 7K and then reversed and made new all-time highs and continued the rally. But that's not what happened. We came down lower. Why? Because once this level was broken, it allowed us to retrace deeper without invalidating the origin of this larger impulse. Again, impulses have impulses within them. Imagine a lower time frame uptrend within a larger time frame uptrend. This was our larger time frame uptrend, and this very cleanly subdivides into the 5-wave moves that we like to look for. This is our 5-wave move, and you can actually also subdivide this into each of these 5-wave moves on smaller time frames should subdivide, or usually we'll subdivide into 5 waves within as well. And here's this one right here. Okay, here's the third subwave. I'll make this a smaller degree. I'll make it orange. This was our 1, 2, this was our third wave, our fourth, and our fifth. This 5-wave move altogether made up the first leg of what we expect to be, again, the start of the bull market that began in 2018. And again, the start of the move that would ultimately take us to new all-time highs past 20K, but as we know, much, much farther than that, ultimately to 100K plus. So again, once we completed this and we broke this level of structure, it was then easy to say, okay, now we can retrace deeper. We don't know how low we can go, but anything above this low is now fair game. And it doesn't change the fact that as long as you don't breach this low, we're expecting another massive move like this to the upside. And again, zooming out, that is exactly what we got. And so back here in 2018, again, I was very bullish at these levels. I said the risk to reward favors being bullish here. I said, I know it looks ugly. I know this move is brutal, but at the end of the day, we haven't breached our lows, and therefore I'm expecting 14K to come next. 14K before 3K, as I famously said back then, right? There's tweets on that. 14K before 3K, meaning I don't expect our lows at 3K to be broken. I expect 14K next. And within a month or two, I think we got that, right? And what followed again was the next larger impulsive move, or the next larger 5-wave move to follow this one that took us to our 65K highs. And so again, now we have our first wave up, we have our second wave correction. We're looking for waves of 5, again, the smaller time frames and the larger time frames. We have 1, 2, this was our major third wave, and this brings us to 2021, where we saw our infamous, again, like double top, if you want to call it. again, what I believe to be, again, another ranging structure, okay? At the end of the day, you can see the distinct difference between this top here and this top here, right? This top was more akin to what we'd expect with like a blow off where price goes nearly straight vertical. And then in this case, we had a situation where we put in a major top. We corrected actually, I was like 50%, which is again, another great example why we can't just assume because we had a deep correction that the top is in, which again is what a lot of people tend to do because they'd rather not wait for the confirmation because it's painful to do so sometimes. And they'd rather aggressively call for a top every time we get a deep correction so that if things don't pan out, we don't go higher, they can say, well, I was right, we call the top. Whereas again, I'm looking for confirmations that the top is in based on market structure levels. And again, even here in 2021, we saw a 30% correction. Once again, I was very bullish here because we had not met the criteria of what I was expecting. I did say, and again, there's videos on this as well, still on my YouTube back in 2021, that while we did rally to new all-time highs, we barely cleared this high. And we did so again in a corrective move, meaning we didn't get a clear 5-wave uptrend. We didn't get a series of higher highs and higher lows. What we got was a low, a high, a higher low, and a higher high. But an uptrend, by its very definition, it's a series, meaning plural, of higher highs and higher lows, meaning you put in a low, you put in a high, you put in a higher low, you put in a higher high, you put in another higher low, you put in another higher high. That gives you a series, plural, of higher highs and higher lows. So when we did not get that here, when we got a 1, 2, 3, again, this is just a little range at the top. People were labeling this as the fifth wave. And again, there's ways that we can identify and tell that that's not a fifth wave. It was just a little range here at the top at the end of this 1, 2, 3. So when we got this three-legged move to the upside and we started correcting down, again, I said many were looking for 100K plus here. This was November, right? And again, based on the 4-year halving narrative that people so fondly have been sticking to, they're looking back at 2017 and saying, well, in 2017, 4 years ago, December of 2017, we saw a blow off top, right? That was the end of our last cycle. Therefore, 4 years later, based on the halving cycle, timeframes are all the same, we should expect a blow off top in December of 21. And you can go back and there's, again, the video on my YouTube where I specifically say, I do not expect a blow off top here. Why? Because this is not an impulsive move, meaning it's not a trending move, it's just a choppy range, a corrective move. And so we took these highs and I'm expecting a correction down. Okay. And so I was actually bearish here at 65K plus, and I was calling for a move down. And I said it could take a number of shapes and forms, but one that I think is quite likely is again a running flat. That seems like the most likely scenario to get here. Again, corrections can take many shapes and forms. They can go to different depths, as we've seen. They can be shallow, they can be deep. Obviously, that's not what happened. I expected this zone to hold. We took the highs. I expected us to hold above these lows. We didn't, right? We broke down. So I was wrong on that. But again, this goes back to the idea that a correction can be deep. It can be significantly deep, but as long as it doesn't retrace below the origin of the impulse, the idea is that it was not a major top and we can expect continuation. So once again, I was bullish here. We haven't returned to these levels. Therefore, there's still a good possibility that this is just a really drawn out mid-cycle correction. And so I'm still very confident that we will get 100K plus and a blow off top, right, to end this cycle. The prevailing sentiment, once again, was that our parabolic runs to new all-time highs only occur after the halving and not before, right? The argument was that we're not going to make a new all-time high until after the halving. The first halving occurred here, a new all-time high followed. The next halving occurred here, new all-time high, and what people were calling the top followed. And so the logic that people were following with regards to the 4-year halving cycle was that once again, we've had a big bear market. This was the top of the cycle. We should not expect new all-time highs in our next cycle top until after the next halving, right? Just like it happened in the last 2 instances. I was one of the few that was saying that's not the case. This was not that cycle top. This is just a mid-cycle correction, and therefore I think we're going to make a new all-time high faster than most are expecting, and that is exactly what we did. We broke these highs, made a new all-time high before the halving, the first time we did so in the last decade, and that threw a lot of people off once again. But once again, we were expecting to recover from this 200K plus and make new all-time highs quicker than most were expecting, which is what we did before the halving. And so this, in my opinion, officially debunked the halving narrative, because rather than us having to wait for the halving to then run up, we ran up, broke new all-time highs, and then the halving occurred. Despite that, people today still stick towards this idea of repeating cycles and repeating tops. And that's what we're seeing a bit on the high of 126K. We'll touch on that a little bit later in the video. In any case, what we got here was now confirmation that the cycle was not over, in my opinion, because we made new all-time highs quicker than most were expecting. By this point, we were well on our way in what was a very clearly impulsive move. And now it's just a matter of identifying when this impulsive move will end. We identified that this was close to the bottom. We were very bullish here. We said we're looking for new all-time highs and 100K plus eventually. And now we're looking at when will this next impulsive move end? Just like this one back here ended and just like this one back here ended, right? This final fifth wave of a cycle that began in 2018. We had the high, we had the low, we had the higher high, we had the higher low. This is the final higher high that would confirm a 5-wave uptrend, a significant uptrend on this very high time frame. And so when this fifth wave ends, then again, again, what does that do, guys? When you complete 5 waves, it opens up the doors to a much larger correction. So that is why this top is so significant and so important, because when this 5th wave finally does end, which it may have now, we'll talk about that a little bit later, ultimately what that means is that this larger 5-wave cycle may have finally ended, the cycle that began in 2017, 2018. And what that means is what I believe will be the biggest, largest, longest bear market that we've ever seen in the history of Bitcoin. Now the question is the cycle over, right? And we're going to, again, touch on that here shortly. Now you get the idea of where we are on the macro, and now let's go to the current move that started off at 15K, and again, talk about why this 74K level is so important and why it was the designated level of invalidation on our current rally, okay? Now, once again, back here from 15K, using the same method of analysis, using the same idea and concept of being able to identify the start of significant uptrends and keeping those as our key invalidation levels, we had so many instances on our way from 15K where we got deep corrections and people were freaking out. So many instances where we got corrections and people were calling for new lows. In each of those instances, we use the same method of analysis, the same ideas, the same concepts to identify where breaks of structure actually mattered and where they were less significant. I'm expecting this at this point to be the start of a larger move to 100K plus, or a start to new highs at least. And again, for me, this low at 15K was very close to our validation level at 14K. So to me, this should not come below these lows. But it doesn't matter if it comes down to 19K, to 18K, to 17K, to 16K, wherever it may be. It's irrelevant as long as you don't breach 15K. And so a lot of people freaked out about the aggressiveness of this correction and us breaking this key level of market structure, which it was on this time frame. I said, doesn't matter. We're above 15K. Everything else is irrelevant. What followed was a massive pump to the upside at 30K. So now we're starting to accelerate pretty aggressively. Once again, we get a long drawn out correction. Once again, people are panicking. Now the first break of high time frame structure is here at 20K. So yes, once again, this is a 36% correction before we have confirmation. But like I said, that is just what the market gives us. Once again, 30 to 40% corrections on the way up. If you felt like calling for a bear market every time we corrected 30%, you would have gotten wrong 7 times. And even if you waited till we broke prior all-time highs to start calling for a bear market, you would have gotten it wrong here, where we corrected 39%, and this was at 2,900. Okay, we topped at 20K. So imagine selling at 25K because we made a 30% correction. We had no basis, no reason to sell based on structure, but hey, 30% correction must be a bear market, must be the start of a 5-year bear market. I'm going to sell. You would have sold out here. If you didn't sell out here, well, then you probably would have sold out here when we got another 40% correction. So again, it's not about the depth of the correction so much as it is a structure and putting that correction into context of the bigger picture. So once again, once you pumped up to 30K, now the key level is 19K. All this doesn't matter. It's irrelevant until and unless we break 19K. And yeah, that is a 30% correction from the highs, but this is a level that matters. It's not about the depth of the correction. If this impulse began at 21K, then that would be our level of validation. It began here at 19K. It was a very strong move. So what does that mean? A very strong move means that we're very high above where the move started, which means there's more space for us to fall without invalidating the move. It's quite simple. Then we had this correction, right? And then from here at 24.5K, once again, we printed a lower time frame impulse. Those of you who follow me should remember, and probably do remember, I was extremely bullish at 25K. We came within a couple $100 of breaking our structure here, but we didn't. And once again, we were able to identify that this move here was an impulsive 5-wave move and likely the start of the next leg to the upside. So once again, where was our invalidation? Here at 25K. After correcting from a high of 31K, and especially after seeing this breakdown here at 25K, almost everyone was very bearish and was looking for a sweep of these lows at 24K. And then we're looking for a move down to around 20 to 22K, this area here, which is a logical area if this level was lost. It's a logical area because once again, it's right above our other key level of high chain frame market structure. And it's the level that preceded the very strong move to the upside. So this is a logical area to test. I'm not saying it's not. And once again, it would have been fine if we tested this level. Why? Because the origin of our last impulse was here at 19K. So this could have been, right, what we call an expanded flat. But the reason why we were expecting us to not do that again was because this move up here was not corrective, it was impulsive, right? And so whenever we get an impulsive move, and sometimes they're easier to identify than other times, we assume that the lows will be defended and we don't change our stance unless they're broken, because there's no reason. Just like we had the low put in here and we pumped up, we assume that these lows will be defended, and it doesn't matter how deep we correct as long as this level isn't breached. The same applies right here. So once again, we had people screaming for much lower. I was very bullish, and despite the fact that we got literally within $200 of invalidating, I said, look, we're very, very close, but we haven't invalidated yet. A lot of people at this point were saying, throw the towel in, we're at 24.9K, because I've been saying for a long time as we were correcting here that this is the invalidation. It doesn't matter what happens above that. But a lot of people were calling for me to throw in the towel. They're saying, you're wrong, admit it. We've fallen down. We're going so much lower. And I said, look, I'd love to agree with you, but we have an invalidation. Frankly, it doesn't matter. This is all noise until and unless something changes. And that change would be invalidation of the key level, which at that time was at 24K from a high of 31K. Again, that means that we have to wait for a 22% move to get confirmation of some sort of invalidation here. And we got a 20% move, but we didn't get a 22% move. And that literally made all the difference here because we didn't hit invalidation. And what followed again was the next impulse, right? And this took us then to 40K plus and ultimately new all-time highs. I very distinctly remember right here during this move as well, we had a range form, okay? During this range, we had a sweep of the highs and a sweep of the lows, what we like to call an expanded flat. But again, a sweep of the highs and a sweep of lows of range and then continuation. And once again at these levels as well, we had tons of people calling for moves back below. All of these built up lows at 30K. Once again, I said I don't think that's going to happen. We were bullish here. We made a little low time frame 5-wave impulse. I got very bullish here at 39K and we rode that all the way up to 70K, almost 100% rally. And this was actually one of the best trades I've ever taken in my life. I got a fantastic entry here because of this low time frame impulse. Invalidation here at 38K. Went in pretty heavy on it. Beautiful trade. Again, one of the best trades of my career. But again, that was because we were able to identify where important levels of invalidation were and react accordingly. So then we popped up here, and then once again, we got this 8-month long correction. We actually had a scenario here, which is interesting that I want to point out, where early on in this 8-month long correction, we had what looked like a little base formed here. For those who are familiar, we call this like essentially a triple tap. The idea is a range forms, we sweep below the range lows, deviate below them, and then we reclaim it and we hold the lows of the range, and that's what we call a triple tap, 1, 2, 3, with the second tap going below, the third tap hitting the range lows or falling somewhere around the range lows, and then we see expansion from that. And so typically this is a bottoming formation. So when we got this early on, we already know our key level of validation is where? Down here at 38K. Okay, and again, I know that's low. I know that's a big drop. But again, the idea is simple. We've formed an impulsive trending move here. Until and unless we break below it, we can't assume that the trend is over. This is the same concept as what we did back at 3K. And remember, the 3K to 14K rally, imagine this is 14K, this is 3K. That came all the way down to here, like 3.4K, and we reversed. So the same concept being used again. And again, I don't get to decide where these levels are. They just present themselves based on what the market does. And it's not my decision or not my choice that we have a very key level of high time frame market structure down here at 38K when we're trading at 73K. And I said the same thing back then that I've been saying. As long as we don't go below 38K, whatever this is, it's going to resolve, and it's going to resolve to the upside, and we're going to continue. Where? To 100K plus. So this is where when we're at 73K right now. In any case, we got this correction, we got this little base form, and this is potentially the start, in my opinion, at the time of the next impulse up. We know that we're expecting one, regardless of how low we go. So now it's a matter of trying to identify the bottom of it. If you can do that, then you can get an early jump on the next major leg to the upside, which again, like we did back here at 38K, can prove to be very, very lucrative. So if you're an active trader, you're looking at these lower time frame moves. If you're not an active trader, and if you're a spot holder, or you're buying and holding for the long term, all of this stuff is irrelevant above 38K. And I said that at the time many, many, many times. So I said, irrespective of what happens here, as long as we're above 38K, we can expect another major leg to the upside. Now, as I'm a trader, I was actively trading these swings in between. And so I was bearish at these highs. I was bullish here at these lows when we made this triple tap base and we got this move to the upside. Again, this looks like a potential 5-wave move. So once again, I was bullish here and I had marked off invalidation at these lows. We broke those lows. We invalidated the idea. And in this case, for example, you had a tighter invalidation because just like we had here, once we had this move up and we were correcting, we had our tighter invalidation based on the lower time frame move. But when we print a higher time frame move, now you have a wider invalidation. Okay, so every invalidation is relative to the time frame as well. If you're able to identify a lower time frame impulse, you have a tighter invalidation. If you've printed a higher time frame impulse, you have a higher time frame invalidation for the higher time frames. Printed this lower time frame invalidation, I was bullish, it took a long here, got stopped out here when we broke it. That was my first sign that we're not yet ready to move up. So what followed then was months more of ranging, and almost at every local top here, I was bearish, 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 bearish. Bullish at these lows, invalidated. Once again, we popped up here, bearish, we tanked down again. So at this point, we're just trying to identify when there's a shift in structure, when there's a shift in trend, and when we're looking to go back up to the upside. Now, lower time frames, that impulse was not clear to me at all down here. And this is one of the mistakes that I made. I was not able to identify after 8 months of us essentially correcting when the next impulse to the upside started. And so we got this move to the upside and I was caught off guard. I was not expecting this impulsive move yet, but I thought at this point in time that we were going to get another one of these fake outs and more drawdown, and this was going to continue for a bit longer before we were ready to make the next move to the upside. And here we finally hit 100K, which is a target that I had in my mind since 3K Bitcoin, and more importantly, since we put in our low of the fourth wave here at 15K. 100K plus was always my target for the final fifth wave to the upside, and finally, after all this time, we had achieved that. So 100K plus was met. That minimum criteria had now been met. Now it was a matter of identifying if the move is done yet or if we're still working on this larger structure to the upside and it's not quite finished. I talked about it in a video that I made some months ago. And in that video, I basically explained the logic behind expecting another, impulsive move to the upside. And if I take this off of log scale, you can really see how aggressive this move was. But in that video, I talked about why I didn't think the cycle was over, why I thought we'd make a new all-time high, and why after this final fifth wave that should end in a blow off top, which is peak euphoria, we would then get, the biggest correction that we've ever seen in the history of Bitcoin. Part of the context of having the biggest correction we've ever seen is that it's usually preceded by the biggest rally we've ever seen. Euphoria follows with massive corrections, and the biggest corrections that we've had in the history of any market, not just Bitcoin, but any market, occur after parabolic blow off tops. The more euphoric people get at the highs, the more irrational exuberance there is at the highs of this market cycle, the more fear, despair that plays out after in the crash that follows, right? And there's some historical traditional market analysts that typically say that anytime you get sort of the parabolic blow off top, you should expect at minimum an 80% correction of that top. And again, that is just based on the idea that markets ebb and flow, just like the ocean. When you get a big wave, you get a deep pullback before the next bigger wave. Anytime you get a straight up vertical rally, the ensuing correction is going to be that much more devastating, okay? Now, the difference between a blow-off top and what we see here is that a blow-off top is a situation in which a parabolic straight vertical move is made, and it is so aggressive and so violent and so euphoric that when we finally do correct from it, the correction is just as violent, but more importantly, we fail to reclaim those highs because that was the peak of euphoria, the peak of greed, right? If we reclaim those highs, as we did here at 110K, it tells us that this was not peak greed, peak euphoria, it was not the peak, and so this is not a blow-off top. This is the definition of a ranging top, right? Or ranging local top. And you can look at basic things like the Wall Street cheat sheet, and you can see on that typical market cycles will end, the biggest market cycles will end in blow-off tops. We can look at all different types of markets as well, and we can see that this is the case for any market, really. It's not limited to Bitcoin, or it's not limited to traditional equities. But here's an example, which is silver. And again, silver at a blow-off top back here in 1980, you can see we put in that high, 30% drop in a week, and then within a few more weeks, all the way back down to $10 from a high of 48. So this was a massive crash, and the aggressiveness of this crash and the failure to reclaim these highs is testament to the aggressive rally that preceded it, the straight vertical price action that led to this blow off top. And as you can see, it took us another 30 years to get back to those price levels, okay? And when we finally did, what did we get? Another vertical rally, which then led to another major correction, and then it took us another 15 years to get back to those highs. And now what are we seeing now? Again, another vertical expansion, another parabolic rally, which is why the ensuing correction could take a number of years to play out if this was our blow off top. You can see the same thing in gold. You can see the same thing in traditional equities. This is the SPX, and this is another thing that I want to point out too. You can see here that back here in 68, we got a correction that lasted 2 years. We then reclaimed this high. We then got a correction that lasted another 2 years, and then we went on to continue the cycle, right? So this was, despite it being such a significant correction, which it was, right? This was a correction from 68 to 74, essentially. This was all one big, again, expanded flat correction. Despite this, we then continued on even higher and more aggressively for the next leg of the cycle, which was this leg. And then again, we had another, what we like to call an expanded flat, where it came down, took the highs, took the lows, and then what happened? We went into an even more aggressive expansion. And this is all leading to what is very clearly a blow off top in the making, okay? So anytime we get these sort of mid-cycle corrections, what we like to call expanded flats, you can view this, and this is how I view it, as basically one large 5-wave move in the making. And so again, cycles within cycles. And again, this is the case for every market, not just Bitcoin, but every market has cycles within larger cycles, within larger cycles. And so when you get massive corrections that last for decades or last longer than prior corrections, they're corrections of a larger degree, and ultimately they're all playing a role in some cycle of, again, a greater degree. And the corrections that follow will be relative to the strength at which these cycles peaked. So again, because we got these sort of ranging, chopping segments of the market that happened, this is the SPX, even just like 68, you can see here a very clear uptrend with higher highs and higher lows, and we had some deep corrections on the way. Again, we didn't have any significant breaks in market structure. I would argue that we had a pretty decent break right here of this 52 level. Up until then, very clear higher highs, higher lows, and And then this is where we first had a higher high that ultimately was broken, but you can see it was sort of a fake out. We had another expansion, and then we had this chop that overlapped each other. And this was a significant pivot, right? After we broke this low, which was our last pivot, this became a significant pivot once we made a new rally to all-time highs. You can consider this like an impulsive movement. And so once again, the argument can be made that all this was chop that didn't break the lows here at 51, which would have been about a 50% correction off the highs. And while it took some time, what followed that was, again, even more aggressive expansion. And I can take this off of log scale, and you can see that even on a linear scale, the rate of expansion here was significant, right? But it pales in comparison to the rate of expansion here, okay? And so what this tells us is, again, that while this was a significant correction, and despite us breaking this low, it was still part of a larger correction. We didn't get a blow off top here. This was a pretty linear rise, right? It started to accelerate a little bit here at the top, but not vertical. And because it was not a blow off top, we did see a pretty deep correction. But then we got another phase of expansion that was even more aggressive, okay? And then if we follow this up here, this was looking very, very parabolic. We had a significant high here. We corrected for a couple of years. Now keep in mind that the traditional markets move slower than Bitcoin, right? Slower than crypto. So again, what we had here was a rally from 74 to 2000. That's a 25-year essentially rally. A 25-year rally versus a 2-year correction before making new all-time highs tells us that the degree of this correction is not like a massive cycle-ending correction. Why? Because we corrected for 2 years and then we move back up to these highs. At the same time, the move up was a marginal higher high, and then we corrected again. And when again we broke these lows here, this is again the expanded flat idea, the expanded flat concept that we have. Again, like today, this is once again, imagine this being 74K, and we've broken it, okay? And you can see here that was essentially a fake out. And that's one of the scenarios that we're going to cover later on in this video because there's a few. But the point being that we didn't have a blow off top, or we thought what might have been a blow off top, but after we recovered it, after 2 years of correction, it confirmed that this wasn't a blow off top. Instead, it was rather just a pretty big range after a 25-year bull market. And so then again, without the lack of that blow off, what we can expect is that this is a mid-cycle correction and that the true blow off, true peak euphoria is yet to come. And then what followed that was what is, as we can see today, once again, an even more aggressive rate of expansion. So while we had this significant rate of expansion here, and it did accelerate here, the rate of expansion that we have today is even more aggressive, because if we extrapolate this out, we can see that what are we doing? We're expanding at a even more aggressive rate. So all this is building into what is a parabolic advance. And that is literally the definition of a parabolic advance, a continued rise at an increasing rate of expansion, increasing rate of aggression, increasingly steep, right? So again, if I take this off a log scale, you can barely even see the first segment of this bull cycle because we've gone up so high. But we had an initial segment that rose at a certain rate of expansion, then we got even more aggressive, and now we're getting even more aggressive. And this is all building to what will be, in my opinion, a multi-decade top on traditional equities. And once again, I shared a chart where I talked about how where we are on Bitcoin, I think, is similar to where we are here. Imagine this is Bitcoin at 60K, this is Bitcoin at 30K, this is Bitcoin at 69K, this is Bitcoin at 15K, and then we had that really big breakout. We've been expanding aggressively since then, and now for the first time here, we have essentially broken our first key level of market structure, right? We had the slope of expansion that we were tapping and going up with, but we weren't kind of accelerating parabolically, right? We were going at a pretty steady linear rate here, and then we saw this big drop down. So this was a 35% drop on the SPX. We broke this trend line, we saw a very aggressive dip, we broke all these key local lows, but again, our last impulse began at these lows here at 1775. Again, the charts are on Twitter, and I shared this publicly at the time. I was bullish here at 2200 when many were saying this was the end of, well, the world really, because this was during COVID and people were arguing over toilet paper. But once again, I was bullish here. I said, look, I know it's ugly, I know it looks bad, but our last impulse began at 1800, and so unless we go below that, continuation is expected. We recovered from this and we continued, and now you can see once again that accelerating slope of regression. Now, if we compare this to where Bitcoin is at today, you can see once again that we are in a similar situation. And so imagine this was, again, this level here, this level here, this level here, this level here, just like we had on the SPX, what we call, again, an expanded flat. Takes the highs, takes the lows, okay, like we did here. Looks really ugly, looks devastating, the world's gonna end, and then we rally and make new all-time highs, okay? Now what we got here, again, on this segment, is once again, a pretty relatively linear rise, right? So we had a little bit of expansion here in terms of how aggressive the rise was, but after that, you can see here that we pretty much followed this trend line up, okay? So this is, once again, not a parabolic advance. And we know that because after hitting our top here, we ranged here for over a year, and this is not what a parabolic blow-off top looks like. When we put on a major top, we don't reclaim it in a number of months. When we put in another subsequent top, we don't reclaim it shortly after, and we don't range here between 80K to 100K for over a year. That's not a blow off top. So once again, it's similar to what we got here in the context of like where we're at. It's similar to this rise here, but not necessarily that parabolic expansion that we were expecting. So if this isn't a parabolic expansion, then just like we had on the SPX, we had one expanded flat mid-cycle correction, another expanded flat mid-cycle correction, and now we're getting a parabolic advance. Is that the same as what we have today, which is an expanded correction, expanded flat, again, before what would be the actual parabolic advance? That is one of the scenarios that we must consider. There's a number of scenarios. We're going to discuss them all here, but I just wanted to show you guys why it's relevant that there's no blow-off top here. If there's no blow-off top, then we haven't hit peak euphoria, we haven't hit max greed, etc., etc. And again, that parabolic expansion is typically the end of a larger cycle. And if we're not getting parabolic expansion, if we're not getting euphoria and greed, then we're typically not seeing the end of a cycle. And I say typically because, like everything, there's no guarantees ever besides death and taxes, as they like to say. But the point is that it's highly unlikely that this is the end of a massive cycle. This comparison is just to kind of show you guys how there's a clear difference and distinction between a correction that ends in something like this, a range, versus a correction that occurs after a blow-off top. Okay, so now that we've established that we clearly don't have a blow off top here, let's talk about really briefly why 74K was relevant in this context. So once again, we're identifying these key levels of impulsive movement. We had, obviously some sort of a wave one here. There's a few different ways you can label this, but for argument's sake, we'll go with the assumption that the top is in, right? And that we've completed a 5-wave move from the upside. Again, this would be the first wave, second wave, third, fourth, and fifth, okay? Again, just like I said before, until we get some sort of a break in high time frame structure, we assume continuation, okay? Back here, when we got our fourth wave here, we got our fifth wave up here, there was a chance that this was the end of the cycle, right? But what happened was he corrected down, and then off of these lows at 74K, what did we do? We printed what looks to be a pretty clear impulsive move to the upside, okay? And again, that can be noted by the key low that we put in, the high, the low, the higher low, the higher highs, okay? So it looks like now we've started a new uptrend, and that is where this key level came from. And again, even at the bottom here, before we started this move to the upside, we had a lot of sweeps of these lows, which as we know is a way to kind of grab liquidity before reversal. So we had bottoming signs here. Then we got what looked to be an impulsive move. You can see here by the strength of these moves to the upside with the corrective retracements, this is what an impulsive move should look like. And so then logically, the same way that we identified bottoms at all these subsequent levels at the lows, and the same way that we had our key high time frame invalidation points that never got breached, we applied the same idea here, okay? Now in this case, it didn't work out, okay? And that happens sometimes. No method in these markets is infallible. No method is without its instances where it doesn't give you the result that you're expecting. But again, I've been doing this for 7 years, and over my experience, these ideas have served me well far often than they haven't. This method is the reason why, despite us having a 33% drawdown from these highs, or us having a 23% drawdown from these highs, or even the 22% drawdown from these highs, or even the 30% drawdown from these highs, I was adamant that we would see higher highs before the cycle is over. And that allowed us to ultimately be present and aware of continuing upwards price action till 100K plus. A large correction is enough to shake you out. Forget 74K. You probably would have exited at the bottom of this 34% correction at 48K. You wouldn't have held to 100K because you would have thought this was the start of the next bear market. In fact, we did break the all-time highs, and then we saw a big correction, and so many were calling this the start of the next major bear market, and we remained adamant that the cycle wasn't over and that we would see higher highs and 100K plus. And again, that's exactly what we got. So I understand that in situations like this, where we've printed a potential impulse off of a low level and then seen what was a very strong move to the upside, a 60% rally, I understand this is not ideal in terms of a higher time frame invalidation level. But the fact of the matter is that this is the first level at which it makes sense to be concerned to some extent, because up until this level is broken, what you have here, no matter how low we go, is just another higher low. Exactly like we had here at 25K. Exactly like we had here down at 3K. Exactly like we had on every other major deep correction in this market that ultimately was not the break of higher time frame structure and ultimately resulted in higher highs and continuation of the upside. So when you're dealing with higher time frame trends like this and you're looking at the macro picture, yes, sometimes your validation levels are going to be lower than you'd like, but we can't control that, guys. We have to work with what we get. And so this was a key level of validation that I talked about for 5 months straight. And people kept saying, even as we got close to it or as we corrected deeper, you're wrong, throw in the towel, why are you still bullish when we've corrected 30% from the highs? And it is a little bit interesting that this sentiment was so prevalent. Even from this high here, we had people saying the top was in earlier. We made a new high here October 10th, and that's a whole nother story about what happened on October 10th. but we corrected from here down to 32%. Even at 84K, guys, this depth of correction was exactly what we got here. We got a 34% correction off the highs, and we continued on to new all-time highs. It was exactly what we got off of this local high right here from 109K. What was that? That was a 32% correction, which resulted then in new highs. So even though we'd seen that twice before, and everyone calling for the cycle to have been over was wrong, we got the same 32% correction here at 85K, and you had tons of people screaming about why the top was in. And we'll go over the reasons why people said that as well here in this video, but this is not enough. And so rather than saying, yes, the top was in, I was wrong, time to flip bearish, I simply said, look, nothing has changed. We've gotten this in the past. Our key level of validation hasn't been hit. And yeah, as much as I'd love to be covering my bases and say the top was in, just in case I'm wrong and we go much lower and I can say, look, I flipped bearish in time, I'm not here to please the crowds or to say things people want to hear. And I made very clear why this was my level of validation far before we even got close to it. And I explained the rationale and logic behind it. And again, that rationale and logic has served me well, since 3K for the most part. So there was no reason to change my bias until unless this level was hit. Now that it has, I can reevaluate, and that's what I'm doing in this video. Now that we've explained why this level was relevant and significant, and now that we've talked about why we've breached it, let's talk about the bullish and the bearish scenarios. So there's a few distinct scenarios and possibilities that we have here, and I'm going to cover all of them. And to be very frank with you and very upfront, now that we've hit 74K, they're all quite viable, and I don't lean necessarily in one specific direction or other. I can see a couple of different possibilities. I'll cover which ones I think are more likely, but this is a situation where I'm sitting and watching and waiting to see what happens. And again, as I've been saying for months now, the ROI here is not really in Bitcoin, it's in altcoins. And to me, that's pretty self-explanatory, but it's pretty hard to grasp for a lot of people that are new to the space or that have gotten in over the last couple of years on altcoins that have just been bleeding. And again, as I've said, since 2023, the biggest alt runs happen after Bitcoin has had its time in the spotlight and typically after a Bitcoin top, end of the cycle. And so anyone expecting altcoin runs prior to that will probably be disappointed. Back here at, what was this, like 16, 70K, 20K. Bitcoin dominance was, I think, around 30 to 40%. And I said specifically, again, I'm expecting at this point in time a massive rally to 100K plus back when we were at 20K. And so I specifically said, don't expect altcoins to shine anytime soon. Bitcoin dominance should continue to rise to at least 50%. Why? Because this was the start of a much larger rally to 100K plus. And so Bitcoin will lead out of this correction. Bitcoin will steal the spotlight. Bitcoin dominance will rise. And then eventually, sometime after prior all-time highs, we'll see alts start to react. And ultimately, the biggest altcoin rallies will happen once Bitcoin tops, just as we saw in 2017. And again, we'll go over the data that suggests that as well. But the point was that if you came in the last couple of years, you have this very pessimistic outlook about altcoins, and that's totally understandable because I get it. As long as you've been here, whether that was entering in 2023 or even 2022, the last 3 or 4 years, altcoins haven't done much. And so I understand the skepticism around an altcoin rally. From what you guys have seen, that's no longer realistic. But again, for someone that's been here since 2017, someone that's been here since 2017, 7 to 8 years ago, I've seen this play out many times over the years. And it's not surprising that we haven't seen alts make their moves yet because Bitcoin is doing what Bitcoin does. And when Bitcoin leads, altcoins lag. And that's natural and normal to expect. But if this is the Bitcoin top, okay, if this is indeed the end of the fifth wave here, this was the end of our 5-wave move, and this was the end of the larger 5-wave move off of 3K, then what it implies is that the altcoin rotation will now finally begin, and we'll have some data. I'll share some data to support that argument as well. But again, it would imply that the top on Bitcoin is finally in, which means that the altcoin rotation that I've been talking about that should happen post Bitcoin cycle top, as I've reiterated many, many times, is now finally due. Now, if the top is not in, okay, and this is not the end of this fifth wave, or this is not the end of the cycle that began in 2018, and we'll cover the arguments for that, it means that our major altcoin rotation may not be coming sooner, may come later. And again, the way I look at it is kind of like a win-win. Again, the higher that Bitcoin goes when we get this major altcoin rotation, the more money will flow into alts, right? Obviously, if Bitcoin's at a 3 trillion market cap and the top is in and we're seeing a multi-year bear correction from here, then there's only a certain amount of money that can flow into altcoins. If profits are being taken from Bitcoin at 100K, maybe profits are realized in the amounts of hundreds of billions, and some of those profits will again flow to altcoins, and that's how we get the alt season. But if the top is not in and Bitcoin is correcting but is ultimately going to go higher, we'll discuss that again in a minute, then it means that the rotation may not happen as soon as we'd like, but when the rotation does happen, instead of maybe hundreds of billions of dollars flowing into altcoins, you might see trillions of dollars flow to altcoins, right? If the crypto market cap and Bitcoin market cap specifically is at 1 or 2 trillion and profits are being taken, versus if it's at 5 trillion, for example, and profits are being taken from Bitcoin at $5 trillion of market cap, then in the latter scenario, we have a lot more money that can potentially flow into altcoins, which means ultimately a bigger alt season. And one common argument I always see about the alt season not occurring is that people say there's too much dilution now, right? We have too many altcoins in the space, and so it doesn't doesn't matter that we're trading at 100K. We're not going to see rotation like we saw in 2017 because now there's 10,000 more alts. And again, that kind of oversimplifies the reality of the situation, which is that, yeah, I understand there's 10,000 more alts. In fact, there's hundreds of thousands of more alts, but 95% of those are junk meme coins that can be created at the click of a button, and that will not attract any meaningful amount of liquidity, right? So when we're talking about a rotation of money from Bitcoin to altcoins, I'm not saying that the money from Bitcoin is going to get split up evenly into 10,000 altcoins. That's not how it works, right? The money from Bitcoin will be put into specific altcoins that have some level of merit or value or speculation that suggests that attention should be focused on them. And that is not the case for 95% of altcoins out there. So when we talk about dilution and an increase in altcoins, the fact that there's 100,000 altcoins is relatively irrelevant, because out of those 100,000, maybe 97,000 are not worth anything and are sitting at zero or with barely any liquidity and have no reason to attract any attention or any of the money flow from Bitcoin. Whereas maybe there's 100 or 1,000 coins that do have some fundamental reason to attract attention, whether that be, again, utility prospects or some sort of a speculative bet or a chart setup or something that may attract capital when there is a rotation, right? So dilution is relatively a null and void point, because I'm not talking about an alt season in which every alt pumps. I'm talking about an alt season in which money rotates from Bitcoin into a select basket of high quality alts that are either printing high time frame bottom accumulation patterns or that have some sort of a utility function that makes them actually worth something. If the Bitcoin top is in, now with the break of 74K, it's the first time that I'll say there's an actual argument for that. If the Bitcoin top is in, then alt season sooner rather than later. If the Bitcoin top is not in, the alt season may not occur sooner, and it will occur probably later, but it will occur at a greater scale. And so either way, in fact, I'd prefer to wait. I would prefer to drag it out a little bit longer and get more returns on my altcoins, but I know not everyone shares that opinion, and a lot of people either don't have the patience to wait for those types of gains or kind of fed up with the fact that they waited so long already, and I understand that, but getting a 10x is cool, getting a 30x because I waited 2 years longer is worth it. So that's the way that I look at these things. So let's talk about the potential bullish and bearish scenarios, okay? We'll first cover the bearish scenario. The bearish scenario assumes that the 5-wave cycle that began in 2018 with our first wave off of 3K to 13K is finally over. And that assumes that we topped here at this 5th wave and that we are now in a larger bear market. Now, this bear market, some might think will be similar to this bear market here, okay? But if this is the end of a cycle that began in 2018, then the depth of this correction or the magnitude of this bear market should not be what we saw in 2021 or in these years here. It should actually be worse, because this bear market was correcting this leg of the uptrend. If this is the end of the uptrend from 3K, then the bear market that we're seeing now is not correcting this leg from 15K up, which was a few years of price action. It would be correcting the entire move from 3K to 126K that occurred over the last 7 years. And when we're correcting a larger bear market, the expectation is that the correction takes longer and goes deeper, basically bigger in scale in both time and price, or in time and or price, than prior smaller corrections within the larger cycle. So if this is the end of the cycle from 3K, yeah, we could see something like this, okay, and a reversal and continued all-time highs by 2027. But more realistically, we would see something like this, which would be a much more drawn out, a much longer correction before the next major cycle is ready to begin, maybe in 5 years plus. And so this is what you'd expect. This is I guess you can say the worst case scenario, assuming that our bear market top is in and that this ended the cycle from 2018. This would be the worst case scenario, which would be the start of what could be a 5+ year bear market before our next period of expansion, okay? And if we had a blow off top here on this 5th wave, and if we didn't get this ranging top, then this would be my primary expectation. In fact, it would be worse than this. We would go lower than 52K. This, in terms of depth, I think is relatively tame for a correction that's correcting price action that began in 2018. Again, if we're correcting a move that began at 3K, then if we just use our fib retracement tool, a 50% correction of this move would be at 65K. But if we get something like a 70 or 80% correction, which we've seen now in Bitcoin over 4 times, then we're looking at a move down to 30Ks. If we get a move that's deeper than 75%, let's say 85%, which again is in line with the last 3 major bear markets we've had on Bitcoin, then we're now looking at a move down to 20K. This, what I've depicted here, is actually more tame than what I'd expect. Let me redraw this so you guys get an idea of what I'd expect if this is the end of our cycle from 2018. It would be something more like this. And again, it could take all kinds of shapes and sizes and forms and whatever you want to call it, but it would be pretty devastating. And I've always said that I think the next bear market, the next cyclical bear market, secular bear market, the next major bear market that's correcting price action that began at Bitcoin's inception, that'll be the most brutal one we've ever seen. I've always said that I expect, entities like Michael Saylor to get wiped out in that instance. And again, Michael Saylor's average on Bitcoin is now 74K. That's another whole story which I don't want to get too much into because this video is already going to be a lot longer than anticipated. But in a situation where we're bearishly correcting for so many years and lingering down at these levels, potentially for 5+ years, people like Michael Saylor and those types of entities ultimately will get flushed out. And again, I don't want to comment too much on that because I know I'm going to get people in the comments that are going to start with the whole he can't be liquidated thing, but I've talked about this on X and we've examined it in depth, and he can get liquidated. It would take a lot, and it would take a prolonged bear market at levels far below his average entry, which is now 74K, for a long enough period of time to cause that. And so that's another reason why many people say he can't get liquidated, because, and this is why he says he can't get liquidated, because in his mind we're going to $1 million plus and we're going to 30 million or whatever by 2030 or whatever. So in his mind there doesn't exist a scenario in which we correct so long and so deep for so long that causes him to have to sell his Bitcoin. But that precise scenario does actually exist, and I've talked to people much smarter than I am about this, and we've gone over all the possibilities, and they all agree that yes, if we were to see a prolonged bear market that lasts for 5 to 10 years and Bitcoin trades at like 17 or 20K for that amount of time, then yes, Michael Saylor would have to sell some of his Bitcoin, and that would essentially be a capitulation of MicroStrategy. But again, that is a topic for another video. In any case, this is the absolute worst scenario, okay? And again, if we had a blow off top here, then that is what I would expect to happen. Because the scenario that I talked about in the video that I made a few months ago about 1920s like boom and bust, and I was basically comparing our next rally, this was back when we were at like 20K, 30K, I was basically saying our next rally will go to 100K plus, we'll go parabolic, kind of like the roaring 20s, and then we'll see the biggest bust we've ever seen in Bitcoin history, which would be that prolonged bear market. But that scenario again assumed a blow off top, and we haven't got the blow off top. And this is the one thing that prevents me from making that my primary at this point in time. The one thing that prevents me from saying that this is the correction that's going to take us back to 10, 20K for 5 to 10 years. And I know that sounds kind of crazy when people hear it, but you have to remember that just 2 years ago, we were trading at 15K. And as fast as we came down here and as fast as we went up, if this was the start of that sort of bear market, we could come down just as fast as well. And prolonged sell pressure, prolonged bearish pressure that could cause someone like Michael Saylor to have to liquidate and sell his Bitcoin, of which he owns 3% of all the Bitcoin in existence. That sort of forced selling is what could get us to those lower levels once again. And so again, that is the most bearish scenario. And if we had a blow off top, then I would be quite confident that is what we're going to get. We did not have a blow off top. We did not fulfill that final criteria of that sort of parabolic advance that I wanted to see, and therefore I'm open to other possibilities, okay, despite us breaching 74K. So that was the worst case scenario. Now let's move on to the other scenarios, some of which are quite bullish, one of which is a lot more bullish than the others. Let's go over them all. So first we'll start off with an idea that I've seen on Twitter quite a few times now. The idea that is being proposed on Twitter by a number of analysts is that this correction that we're seeing here now that we've broken this key level of structure is really just an expanded flat fourth wave. Again, similar to what we got here, but not as deep. What's going to follow this is, again, that final fifth wave, which will give us that parabolic blow off top that we are missing, okay? This is what would be that sort of parabolic blow off top, which again is that period of aggressive expansion where we go nearly vertical. And this could again push up quite high. It should look vertical. It should be more aggressive than this expansion. It should be more aggressive than this expansion. For a parabolic blow off top, the rate of ascent gets increasingly steeper with time, right? So it should be more aggressive than all these prior rises that we've seen. And so this sort of a rise is very realistic. And in fact, one that goes up to like 200K plus is technically fair game. And again, that's just a testament to how aggressive this rise needs to be and should be. If it's a true parabolic blow off top, again, it needs to be more aggressive than this. It should be more aggressive than this. It should be more aggressive than all these rallies prior that we've seen since our bottom here at 3K. And so it is not a stretch of the imagination to say we could see something like this, okay? And that will be a true parabolic blow off top, peak euphoria, peak greed, peak mania. This is one argument. Now, the important thing about this is that even if this is the reality of the situation, this fourth wave, as we saw back here in 2021, when it was part of the larger 5-wave move from the lows of 3K, this fourth wave can be either just a quick wick of these lows for an expanded flat, or it could be much deeper, as we saw here in 2021. And there is no easy way to tell what we're going to get. And that's why the 74K level was so important, because above above this 74K level, the idea is that there's only one possibility above 74K, right? And that is that the trend isn't broken and that maybe we're making it a running flat and we're going to see continuation. There is no possibility in which we get such a drawn out correction if 74K is not breached. Now that we've breached 74K, there's multiple. And this is what makes it tricky, because maybe we get something like 2021 where we get a more drawn out correction. Maybe we get a scenario where we pull back from here even deeper to maybe 40, 50K, 60K, and then we get that expansion similar to what we got back here in 2021, 22. Or maybe this is a very aggressive fake out that just wicks below 74K and then we rally, okay? And there have been examples like this, not just on Bitcoin, but on a number of assets. And one that came to mind from a post I saw on Twitter, which I'll show you guys now, is this post here by Decode Jar. And again, I recommend you guys giving him a follow. He's one of the few people on Twitter that understands Wave to a kind of an advanced degree, which is very hard for many people to do, and who generally uses it in the correct way, and I usually find myself agreeing with his ideas. And here he's shown examples on traditional equities like Google, where we have that same structure that we're seeing on Bitcoin now, where imagine this A is 74K, where we make a marginal higher high, we breach the lows, and we immediately reverse and continue up. And you can see here, even on NVIDIA, we had a low here, imagine this was 15K on Bitcoin. We have a series of higher highs and higher lows with no significant breaks in market structure, right? On NVIDIA, this impulse that started off of $39, you can see a 1, 2, 3, 4, 5, a very clear high time frame 5-wave move that ends at 128. This is our origin of this massive impulse, and the last leg of this impulse, the fifth wave of this 5-wave move, is down here at $76. So in this case, we didn't even hit that level of validation, but we did put in a significant low, made a higher high from there, and then broke down, cleared that low, failed to clear this low, and then rallied. So these are examples where we just wick below this key swing low and then we reversed new all-time highs. And so in that case, on Bitcoin, it would be something like a quick wick below 74K and then aggressive reversal. And I'll show you guys some arguments as to why I think that that is quite a realistic possibility. It's also worth noting that back here, when we were trading at 75K, we were watching this level right here, which is a high time frame level that preceded this strong move up to the upside. And we were looking for a test of that level. And some of you guys will remember that what happened was we actually front ran it, meaning we were expecting a test of that level, but we actually bounced right in front of it. As you can see, we bounced at 74.4K. This level was at 73.7K. We bounced right above it and we moved up. So this level was never tested. And it's a very key level because it was the level that preceded the breakout of what was essentially almost a year-long consolidation, right? So this level is expected to act as significant support. We expect buyers to step in here when we test it. And you can see now that what we have done today with this move below 74K is we've cleared this wick and we've certainly trading above it. We haven't yet closed the day above it, but we are trading above it. Actually, this is a 3-day chart. On the daily, yeah, we haven't yet closed the daily above it, but about an hour and 16 minutes, we're going to close the daily, and we might close it above it. Okay, that's a good sign. That's similar to what we had here, where we closed above it, and then reversed. It's a liquidity grab thus far into what is a very key high time frame area of demand. And so there's an argument to be made that what we are seeing right now is similar to what we saw on NVIDIA and on Google and many other assets, which is a fake out, breaking a very key level of structure after a very aggressive rise and then continuation of the upside. And I'm going to show you guys in a second here why I think that this is probably, again, with the lack of the blow off top, and with some of the other stuff that I'm seeing, I think there's a decent chance that we could be seeing this, okay? And this would be, I would say, probably the best case scenario. Why? Because it implies that we resume the uptrend sooner rather than later. We don't linger down here very long. Again, many of our alts that I follow, and we'll talk about this later in the video, are at kind of macro high time frame bottoms, and so it makes sense that they'd reverse from here. And so this supports all of that. The only downside to this, I would say, is you guys would have to wait a little bit longer for the alt season, the rotation, because this would imply the Bitcoin top is not yet in, and that this was just a very good fake out. But again, I prefer this because we get higher and then we see an even bigger all season shortly later. And this means you don't have to wait much at these lower prices. We don't have to be very upset for very much longer because it would imply a reversal very aggressively, a very aggressive reversal at that. And the show would be back on the road much sooner rather than later. And this is what would look like off log scale. And you can see very clearly how this is the definition of a blow off top, exactly what we'd want to see for a proper ending to this cycle that began in 2018. Okay, so that's one possibility. I'm going to show you guys one more possibility, which is kind of in between both of these. The implications are also actually quite significant. This next scenario assumes that this was a completed 5-wave move off of these lows, but it was the completion of a 5-wave move, which is part of a even larger 5-wave move to the upside. So the way that you'd view this then, this 5-wave move of a much larger degree of the cycle that began back here in 2018 is not yet finished. Actually, we're going to get a very extended fifth wave. Now, this scenario, I do find it more unlikely. And the reason that I say that is because the implications would be, well, twofold. One, that the correction that follows here won't be as devastating as previously expected. Again, we're not looking at like 10K, 12K like we were before if we had a blow off top. Again, it would imply that we're working on this major wave 2, which is actually very bullish because it implies that we still have a third, a fourth, and a fifth to go, and that this fifth wave will not end for another like 3 to 4 years, okay? I find this personally unlikely, but I'm presenting it to you because it is technically an option. And again, what this would imply is that what we're seeing here is a pretty deep correction, but that would be followed by a blow off top on Bitcoin or parabolic expansion on Bitcoin that is even more aggressive than we originally expected. And why? Because this first leg from 15K to 107K is about a $100,000 move. That allows this third wave to be even greater than that and allows the fifth wave to be even greater than that. Basically a very, very aggressive like parabolic expansion that would drag on out for a number of years. This is not like my preferred scenario. There's not the strongest arguments for it in my opinion, but what it would imply is that the current correction that we're seeing has a higher likelihood of going a lot deeper. Again, in the scenario where we're getting ready for a parabolic blow off top sooner rather than later, the scenario that I just showed you guys, which is the more bullish one, where this is a fourth wave and we're still working on the fifth wave of this final fifth wave. In that scenario, we expect a quicker recovery, a quicker reversal, a more aggressive expansion into a blow off top. Whereas with this scenario, we expect a deeper correction as more likely. Because if this is a continuation of the trend that started at 3K and this 5-wave move segment isn't done yet, then this correction can only go so deep without momentum completely resetting, right? And if this is going to be a blow off top, then the correction should recover almost as fast as we came down, and momentum should push us back up very aggressively. If we end up falling deeper and we get a push back down into like 50Ks or 40Ks, then the odds that this is a fourth wave before a fifth wave are significantly and drastically reduced. And this green scenario becomes far less likely. So if we end up going down here, then this is unlikely. We're unlikely to see something like this if we end up correcting down to 30 to 40K. So this scenario is more viable if we get an immediate reversal shortly after these levels at 60, 70K-ish. If we start pushing down into the 30s and 40s, then that scenario is probably out of the picture and we're left with either the most bearish scenario or this one, which is more bullish but requires more patience as well. And in this one, once again, we correct deeper than most are expecting. We correct to maybe sub 50K, we correct to maybe 40Ks, 30Ks, even 20Ks, but we should not go below 15K. And in this case, we see a more drawn out correction like we saw back here in 21, where we cleared the highs, we cleared the lows, and we see sort of a bleed and accumulation. Again, this is not the scenario where we're seeing a 5 to 10 year bear market. This is not the scenario where we're correcting from 3K. This is a scenario where we're correcting from 15K. We're correcting this leg up. And so it would be more tame, still pretty devastating, but more tame, and we'd recover faster than the scenario in which we're correcting the entire move from 3K. And so in this scenario, we recover faster, and when we do recover, we go on to then blast past 125. At this point, we would almost certainly go over 200K because the first leg was 100K long and we still have a third and a fifth to go. So we go past 200K and who knows how much higher. But in this scenario, this extends our bull market out quite significantly. We might correct for the rest of the year even and then get ready to rally in 2027 and then rally through 2028 to 2029. This scenario, out of the three scenarios, I find to be like the second most likely. The third scenario, because of the lack of the blow off top, I find it hard to believe that this is like a decade-long cycle ending. Again, those typically end in peak euphoria and peak greed. And because we didn't get a blow off top, I'm not expecting the correction to be that devastating. But this scenario would also surprise me a bit, and I'll show you guys why here shortly. This is the alternate, is that we're getting a correction. The 5 waves here have completed, but what we're getting really is just a very extended final fifth wave that takes us much, much higher. Not to millions, not yet, but it takes us much, much higher. Important to note that the scale of these moves, when we get to sort of extensions, can get kind of wonky, right? Like this is not a log scale. So if I were to zoom out and I were to show you this chart, again, the scale of this initial leg up versus the scale of this leg already looks pretty out of proportion, right? Because we had a 10K move versus what is like a 40 to 50K move, right? And you can see the scale of this move then, again, it's much larger proportional to this move. In the formation of a parabolic advance or a blow off top, the scale gets increasingly distorted on things like crypto that are so volatile because we have such massive moves that precede a blow off top that the subsequent waves are each so much larger than the prior ones that the scale looks a bit distorted. In the same way that this first wave was relatively small compared to the third wave in terms of price by like 5 or 6 times, and in terms of time by 3 to 4 times, the same way this fifth wave could be, again, relative to the third wave, 4 to 5 times larger. And this third wave was, again, a $60,000 move. 4 to 5 times larger means this fifth wave could be a $300,000 to $400,000 move. In terms of time, can take, again, significantly longer. And that's why I can't completely rule out a situation where we're just in the first subwave of a larger 5-wave move. The reason that I don't find this as likely as the scenario where we're just kind of forming a more aggressive rally here, there's actually a number of reasons. But one of the first reasons is that, as you guys may recall, I've previously said that I expect that these cycles that have been developing are lengthening in terms of time and are shrinking in terms of price. And I shared charts that explain the logic and rationale behind this as well. And then you'll see one of those charts here in a second. But the idea was simply that ever since our inception on Bitcoin, if we were to zoom out to the highest time frame and look at the origin of Bitcoin to where we are today, this chart doesn't show all that price history. But ever since the inception, we've had blow-off tops followed by large corrections. And over time, the length of time between a blow-off top and the next blow-off top has been steadily increasing. And so based on that logic, I said in 2018, 2019 that we'd expect the next blow-off top not to occur until after 2023. Lo and behold, we're here in 2025 without our next blow-off top, and so that has come to fruition. But along with that, I also said, along with the lengthening time in cycles, I also said that the ROI from cycle to cycle has been decreasing as well. And that's, again, natural and normal to be expected, right? You get bigger gains on a younger, more volatile asset. You typically get lesser gains on a more mature asset and less volatile asset. And so by that logic, for the next blow-off top, I said it should happen under 300K. A cycle like this, where the first wave went all the way up to 126K, and we still have the third and the fifth to go, cycle like that implies that we'll probably cross 300K. And that doesn't match with what I've seen and expected to be the case since 2018 or since the inception of Bitcoin. And so that's why I give this scenario a little bit less weight, and I give this scenario a little bit more weight, that it's possible we're just missing this blow off top and that it's going to come sooner rather than later. It'll take us above 150K, take us below 300K, likely somewhere in the 200Ks. Then we will get our end of the cycle. So that is I don't know if you call this more bullish or less bullish or more bearish or what, but this is the scenario where we have a drawn out extended bull market still. So now we've covered, again, the most bearish scenario, which is that this 126K was the end of our cycle from 3K, and we're now going to see a 5 to 10 year bear market. We've covered the more bullish scenario where we are actually not yet done with the 5-wave move and we're missing a final bull off top wave. And we've now covered the mid scenario where we're not getting a 5 to 10 year bear market that goes down to 10, 20K, or that's correcting the entire move from 3K, but rather we're getting a smaller bear market similar to the mid-cycle correction we had in 2022 that will be followed by, again, much greater expansion to the upside, far greater than 150, far greater than 200, and who knows how high. If I were to rank these scenarios in order of likelihood, I'll just map out the 3 scenarios here so that you guys can see this is the most bullish, this is kind of the mid scenario, and this is the most bearish. If I were to map these out in terms of likelihood, I would have to say that because of the lack of a blow-off top, my 2 primary would be the most bullish and this kind of midterm one. And the least likely, in my opinion, would be this red one here. And again, that is because of the lack of this blow-off top, the lack of that euphoria and greed that we typically see before a decades-long crash, like we've seen in silver, like we've seen in gold, like we've seen in every other market that we talk about. With respect to alt season in any of these scenarios, now in all of these scenarios, it doesn't change my outlook on alts very much. The only thing it changes the outlook on is primarily timing and upside targets, okay? If we're getting the red scenario, then it means that the actual macro top is in here. And in that case, expect the alt rotation sooner rather than later. At the same time, because Bitcoin only climbed to about 128K and we have less money flowing to these alts, the upside targets may not be as high as previously expected, but the aggression with which they rise and the time in which it takes to rise should still be quite aggressive. We should still be able to make some significant gains before the end of the cycle. In the second scenario, in the most bullish scenario where we have this green rally and a more quick reversal off of these lows, the altcoin cycle expectation gets delayed a little bit. Again, we expect altcoins to really have the big rotation post-Bitcoin cycle top. So if this isn't the cycle top and we're getting the green scenario, we have to be a little bit more patient with the alts, but it just means that we're going to get an even bigger rotation when they do come. And at least with Bitcoin, we should see reversal sooner rather than later as well. It doesn't really change the expectation for alts. Why? Because even in the most bearish scenario like we have here, if this really is the macro cycle top, then we expect the rotation to happen sooner rather than later. And in the most bullish scenario, if this is just a short-term bottom, it just means that the altcoin rotation will probably be delayed a little bit, but it'll be even stronger when it comes because we'll have more money to rotate when Bitcoin is trading at a higher price level and we have max greed, max euphoria at the highs. Again, that's the best conditions for a true and proper all season. Now, with all that being said, guys, I've also had some people say, why do you ignore all these indicators that showed us that we were bearish at the highs? Why do you ignore all these indicators that show that we were in a bear market? You know, the high time frame validation of 74K is way too low. By that time, we're already 40% down. Why didn't you pay attention to X, Y, and Z indicator that, you know, quote unquote, prove that we're in a bear market already? And I've already talked about this on Twitter quite a bit, but I just want to show you guys a few examples for those who haven't yet seen it. The idea of indicators that can give you a bullish or bearish bias. I've been doing this for 7 years, and in that time, I've seen all kinds of indicators, okay? I've seen all kinds of indicators with perfect track records that people use to justify a bullish or bearish bias. And I've used them in the past to justify my bullish or bearish bias. But I've been here for so long and I've seen so many of them fail, you know, after having perfect track records, that I've come to realize that you can always find a bullish or bearish indicator to support whatever narrative you may have in the market. If you're bullish on the market for whatever reason, you can find a bullish indicator to support it. If you're bearish on the market, you can find a bearish indicator to support it. And I'll just show you guys some examples of some common indicators that people have pointed to that have pinpointed that we're in a bear market and that we should have seen this coming ahead of time. And I'll show you why these are not reliable metrics of gauging whether you're going to bull in a bear market. And this is why I specifically rely on market structure breaks and why I hold these at a higher level of confirmation than any specific indicator. Now, one of them that I've seen very commonly is this idea of this 52-week SMA close, right? People saying that we've had a bearish close on Bitcoin, which was right here at like 105K. Let me actually pull it up here so you guys can see. 2 weekly closes under the 50-week moving average. So you can see here the argument was made that, well, ever since we've been in a bull trend, we've held above the 50-week. And so getting 2 weekly closes below, the argument was, is confirmation that we're now in a bear market. So the argument was that ever since we closed below it, in fact, even this argument, now looking at this, looks kind of weak because by the time we got our second weekly close, we were trading at 87K, which isn't much lower than the 74K level of confirmation. But in any case, the argument was that you should have known we were in a bear market after we broke down from 102K, or after we closed the weekly at 93K. But the argument was that we've held this line, now that we broke this line, it's the end. And I actually made a tweet explaining why this is a tough argument to make, and it's really not something that can be very heavily relied on because, again, you can read this post if you really want to go into it. But the idea was simply that this is an arbitrary metric that people chose because it lined up nicely with the current price action during the rise from 15K. But if you actually look at it historically, it's given plenty of false signals. The 2 data points where it did mark our tops essentially were major cycle tops. And the point is that whether it's a 50 EMA, 100 EMA, a 20 EMA, on the weekly, on the 2 weekly, on the daily, on the 3 day, you can adjust those metrics, whether it's time frame or whether it's length of the EMA, to whatever you want, and you'll find something that fits recent price action. But if you extrapolate that back far enough, you'll find instances where it completely gets invalidated. And that can be seen so very clearly on Ethereum, where we had so many false breakouts and breakdowns of this level before making higher highs, that this as a metric to rely on is useless. But it's nice that it fits this rally. And because it fits this rally, it's nice to use it as a gauge of a bull or a bear market. But over time, over a long enough time horizon, it's not consistent enough. And we've seen plenty of false signals that have occurred in other coins like Bitcoin and like Ethereum that make it not a reasonable way to trust, right? Now, again, people who have been calling it based on this, again, it gets good engagement because doesn't this look beautiful that we've held it this entire time? And a break below is alarming. And yeah, maybe this plays out like 2021, maybe this plays out like 2017, or maybe it plays out like 2019, where we corrected below for 2 weeks, went back above for 5-10 weeks, corrected below for 2 weeks again, and then fully reversed and went on to make new all-time highs. Or maybe it plays out like Ethereum, where we crashed in 2021, closed below for 2 weeks, closed back above it for 2 weeks, corrected, went up back above it, closed back below it, went back above it for 160% rally, closed back below it, then rallied 90% back above it, closed back below it, went back above it. Like, it's relatively arbitrary metric. And I can take this and I can then extrapolate it to the 100 instead of the 50, and then I can make the argument that we were still in a bull market until we broke down below 85K. Or I can take this and extrapolate it to what people are now looking at, which is a 200. Or I can say the 100 EMA on the 3-day worked very well, right? And so we were in a bull market until we crossed below that at 103K. Or maybe I can adjust this to the 200 EMA, right? And I can choose a different time frame to formulate my bias. And I can say on the 200-week EMA, we were bullish as well until we had weekly closes below, right? And then I can make that argument for why I shouldn't have flipped bearish until we lost low 80 or mid 80Ks. But all of these types of evaluations of bull and bear markets are based on a lagging indicator. Basically, all this tells you when we cross down it is that the rate of ascension is slowed down over a long enough period of time to cross below this particular moving average on this particular time frame, right? A 200-day moving average just takes the average of the last 200 prices on whatever time frame you're at and plots it as a line. And if we break below it, it just means that the rate of ascension is slowing, right? But the rate of ascension slows down a lot. If I were to go to the daily, look how many times we invalidated this metric, right? And then just continued higher so many times. Dip below it here, continued higher. Dip below it here, continued higher. Why? Because all this is telling me is that the rate of ascension slowed down. And we know that because when we get a sideways correction for a number of months, our rate of ascension is slowing down. And so we can naturally expect that at some point during a sideways correction, we're going to cross below an important moving average, in this case, the 200-day moving average. Does that necessarily imply a break in market structure? No. Does that necessarily imply the end of a bull market? No. It's just what happens when we get a drawn-out correction on any time frame. Like I said, you can find bull or bear arguments based on any number of indicators to support your argument, right? And the MACD is another one that people use to support a bearish argument. The death cross is another one that people use to support a bearish argument. And in each of those instances, I've pointed out, like the death cross as well, why they are not reliable indicators. So you can see here that the death cross got its name because the idea was that when you get a death cross, it's the start of the bear market, right? And that's the narrative that people go with whenever we get a death cross, and that's the argument that's made when we get a death cross if you are bearishly biased. But I pointed out here in this tweet that just like moving averages, just like MACD indicators, death crosses are the same thing. They're lagging indicators that essentially just tell you when momentum is slowing. And like we saw here, as demonstrated by the peso, the last 3 times we got death crosses on the daily, they marked our bottoms. And so how can you argue that a death cross or a bearish cross of some indicator, of some moving average signals a bull market or a bear market, when the data shows us that these can be adjusted at different time frames to support or negate any bias that you may have? According to this chart, when we were at 102K and we got our death cross, we should have bottomed within 5 days or 7 days, right? That's what happened the last 3 times. So this was being used again as an argument to suggest that the bottom was in. This was at 102K. So who do you listen to? The guy that has moving averages that show that we broke below and now we're in a bear market, or the guy that's proven to you that the last 3 times you saw these indicators crossing, it was a bottom, right? You will be pulled in so many different directions by focusing on random indicators that you will never have a proper framework with which to evaluate the markets, bull or bear. And so this is why I made this post, right? These types of indicators, while they're catchy and the retail talks about them all the time because they're easy to understand and they sound good on the surface, are usually not accurate measures of whether we're in a bull or a bear market because they don't take into consideration key levels of high time frame market structure. Now, along with that, I'll show you another chart. And this one is a bullish indicator that has marked our bottoms and the start of our parabolic advances without fail since the inception of Bitcoin, okay? And this is again by Decode Jar, and again, a very, very good follow. And again, I want to emphasize that me talking about this bullish indicator is again a simple way that me, as an individual, if I had no other framework or metric with which to gauge whether we're in a bull or bear market, if I didn't understand market structure, I could have used this to justify why we are still in a bull market. I could have used this to justify why everyone who had shared bearish indicators is wrong. Because here I have an indicator that has 4 data points since the inception of Bitcoin that have, without fail, marked every single major rise on Bitcoin and have marked every local top on Bitcoin since inception. And every time we flipped from blue to orange, like we did here, it has marked the start of what is an even more aggressive rally that ultimately leads to our peak or highs some months later. Okay, so this is a monthly chart. So you can see here, back in 2013, when we flipped from blue to orange, it looks like we moved up a little bit higher, dipped, and then we saw our aggressive rally to our top. We then saw a major correction. Back here in 2016, the shift from blue to orange marked again the parabolic expansion that we saw in 2017. We then saw a rise in a Bitcoin top 6 to 7 months later, or like 8 to 10 months later. Back here in 2020, the shift from blue to orange once again marked the start of that third wave, that really aggressive third wave to our rally to new all-time highs in 60K plus. We topped on Bitcoin 10 months later. And now for the first time, the last month, this then flipped again from blue to orange. This again would suggest that we're on the precipice of an acceleration of the upside. Same way we had in 2021 with our move from 30K to 60K. the same way we had in 2017, the same way we had in 2013 when we were trading at probably a couple $100. This chart and these indicators suggest that that's exactly what we're about to see now. And again, this is a monthly chart. So again, as Decode Jar has said plenty of times, low time frame volatility, low time frame corrections on the downside can still occur before that full on reversal, because this is a monthly chart, so it takes some time for these candles to form. But this can be used to argue a bullish bias. And I can find, again, plenty of indicators that would support a bullish bias here as well. And again, like I showed you with the death crosses back then when we were at 102K, there's plenty of indicators that suggest to be bullish there as well. So no matter whether you are bullish or bearish, you will be able to find certain indicators that will be able to support and confirm your bearish bias or your bullish bias, whatever it may be. Which is why my primary method of identifying bull and bear markets is by focusing not on indicators, because I can find any indicator that I want to support my bias, but instead on market structure levels and analyzing and interpreting market structure and data on the price chart. Now, after I do that and I have a bias, these indicators can be helpful in supporting that bias, but the primary bias will always come for me from shifts in market structure and key price levels that have started impulsive movements, as opposed to any one indicator or any number of indicators. So anytime people say, why didn't you shift your bias when these indicators shifted? My response is simply that I've seen plenty of times where a shift in those indicators doesn't necessitate a shift in market structure. And I've seen plenty of indicators at any of those periods of time that would suggest the opposite is likely to occur. Those to me are not reliable indications of a shift, nor are they reliable indicators and shifts of bull or bear market trends. And any analyst who studies price action or has done this for a number of years will tell you that a shift in a trend is based on a shift in a series of higher highs and higher lows. Breaks of moving averages or breaks of lagging indicators or shifts with death crosses, etc., are not necessarily shifts in trends. They are shifts in the market that can kind of preempt a shift in market structure or preempt a break in a trend. But a break in a trend or a break in a uptrend or a downtrend occurs on shifts of market structure, which is a shift in the actual trend of price making a series of higher highs or higher lows, not in a breakdown of some arbitrary trend line or a breakdown of some arbitrary cross or moving average. And this is why it's important to be able to understand and recognize market structure for what it is, rather than relying on any number of indicators that can point you in 10 different directions at any given time. So guys, this video has gone on already a lot longer than I'd anticipated. I covered a lot of content here on Bitcoin specifically, so I decided to make this update a multi-part update. The point of this is to get this content out to you as fast as I can. So I'm going to end this video here. In my next video, which I'm going to start working on within an hour or two, will specifically cover everything else I talked about that I said I would cover. This includes Bitcoin dominance. This includes the others chart, the other altcoin chart, the altcoin index chart. This includes covering all of our alts that I said I would cover. So we're going to end this video, guys. If you guys enjoyed this, please like and share, and keep your eyes out for the next video, which should follow this one within a day or two, that specifically covers our altcoins in context of what we just covered here on the higher time frames on Bitcoin. I hope you guys enjoyed this video, and I'll catch you guys in the next one.